Getting right into the video here, I'm going to be discussing two high growth stocks with you guys here today. And as a result, because these are high growth stocks, they're also going to pose high risk. So just keep that in mind as we go through this video, but it's going to be an exciting one here. You guys know that I'm super bullish on Uber, and I've made videos publicly stating that I own the stock and why I plan to buy more of this stock. Now, if we see another market crasher and Uber gets down to a particular price point, which aligns with my long-term strategy, which I do think it will get there, I will be a heavy buyer of that stock. This is because I believe the market for ride sharing is something that the majority of us will continue using into the future and will just continue growing on a global scale. This is because whether we own cars or not, this is going to be the major mode of transportation in my opinion. And once robo-taxis from companies like Uber, Lyft, and even maybe Tesla at some point come into play, the picture really changes for this industry, and the need for public transit might also shrink as cost can be significantly reduced for a private car driving you around. Now, when you're talking about Lyft specifically, since its IPO in 2019, the stock has been on a downward spiral, down nearly 60% from its highs. Honestly, guys, this has been a very painful stock for investors here, especially if the decision was made early on to invest in Lyft versus Uber. When we're comparing the two here, we can see that Uber is down nearly 15% currently, and Lyft as an alternative is down nearly 40%. And this is because Uber not only has the benefit of being the largest player in the space, but it also has its Eats business, which has helped it tremendously during these lockdown times, whereas Lyft pretty much relies solely on their ride-sharing business to survive. This, in my opinion, makes sense why it's performing so much worse here than its biggest competitor. But as an investor, the current valuation on Lyft may actually be very appealing because there's still room for both players in this space. We'll discuss valuation in a minute here, but first let's take a look at the fundamentals behind Lyft. Lyft here shows us a breakdown of all the different types of methods of transportation that they offer or plan to offer in the near future. This goes from your typical Lyft ride to bikes to scooters and integration with transit and eventually even autonomous cars like the robo-taxi concept. Now, this is what you would expect from Lyft, as Uber offers more or less the same offerings here, but on a much more global scale. In the US, which is the core of Lyft's market, they own around 29% market share, with Uber at around 71%, and this is as of information from April 2020. So what I would say here based on this is that Lyft is no slouch here. It's a good portion of the market that it has and can continue growing year over year, which is why I'm interested personally in this company. Looking at the income statement of the company, this is from the end of 2019, so some of the information might be slightly different here. The company did pull in $3.6 billion in revenue, which ultimately resulted in $2.6 billion in losses due to expansion and other costs. So Lyft here almost lost as much money as they pulled in revenue, which is extremely concerning from an investment perspective. Also, during these tough times of reduced demand for their services, it naturally raises the question if this company will survive or go bankrupt here in 2020. Now, here's a glimpse at the balance sheet of the company, and we can see what their assets and liabilities look like and how the company is doing from this perspective. This may be a bit hard to read, but bear with me here. But what I do see is that their current assets sit at around $3.14 billion, and their total assets add up to around $5.57 billion. Current liabilities, on the other hand, sits at around $2.55 billion, and total liabilities sit at $2.96 billion. So what this tells me here from a high level is that this isn't much of an issue, at least in the short term, with their obligations. But if the company keeps burning through $2 to $3 billion of cash every single year, then they're going to run into a problem very soon. Nonetheless, objectively speaking here, looking at the numbers, I think Lyft looks pretty interesting, pretty intriguing. So let's move on with our analysis. Now, I want to take a second to quickly introduce the metric that I typically use for these type of companies, which are high growth companies, don't really have profits to show for, but they are growing at incredible rates and have a huge potential in the future. This metric uses the market cap and the revenue of the company and figures out a ratio based on that. Essentially, I take the market cap of the company, I divide it by their annual revenue, and I get a multiple. So a multiple here could be 2, 4, 10x, but pretty much what I'm looking for is a multiple of 2x or below, because that usually signals to me that the potential company I'm looking into is possibly undervalued. Around a 3 to 4x would be a fair valued company in my opinion, and anything over a 4x multiple is something that I would consider either a very premium stock to own or a fairly overvalued company as well. But again, this depends on a sector by sector basis. Now, this is just what I use as a starting point, and other factors of course come into play, like growth rate, path to profitability, and all these other questions that you should be asking as an investor. But as a general guideline, this is what I personally like to look at for these high growth stocks. So Lyft currently has a market cap of just under $10 billion and Uber sits at around $60 billion. So this means that Uber is around 6 times larger of a business than a Lyft. But how do their revenues compare? If we look at Lyft here, it pulled in $3.6 billion in 2019, and Uber during that same period of time pulled in $14 billion. But remember, Uber is on a global scale here and also has other segments like their Eats business. Nonetheless, guys, let's use the metrics here for simplicity's sake and calculate the premium we're paying for each business. Lyft's market cap to revenue is around 2.7x, whereas Uber is around 4.2x. Clearly, there's a premium baked into Uber currently because of their market share, diversified business, global reach, and other factors behind the brand. But as an investor, you really need to ask yourself if this warrants this much of a premium over its competitor. Now, like I said, what I typically want to look for when I'm looking for these very high growth companies that have huge potential futures is I want to see a ratio of around 1 to 2x for their market cap to revenue. Now, Lyft does kind of meet this criteria with a 2.7x. It's fairly close to what I'm looking for. But the problem that I see with Lyft is the path to profitability. Uber has shown us that they do have a path to profitability. They actually do want to be profitable very soon. But Lyft is a different story, and profitability may actually take a very long time for this company because they have not proven or really convinced investors of that model yet. Now, there is tons of growth in Lyft. In Q1, they grew by over 20% year over year. So I'm not really concerned about the growth prospects of this company. It's just the future kind of path to profitability that makes me question this as an investment. So when looking at Lyft today, I would say all things considered, all the risks considered, and just based on its fundamentals, anything at a 2x premium or below is where I would consider opening up a position in Lyft. The stock is up 103% off of its lows in March, so getting in today already commands a huge premium of where it was at just a couple of months ago. But if we believe that the current multiple of 2.7x is still low for the company, we have a lot of potential here. If as an investor we have a time frame of say 2 to 3 years, and by then we believe the revenue that they can pull in will be over $5 billion a year, which as an aside is very reasonable and realistic, then at that time their market cap should theoretically be around $20 billion with a fair 4 times multiple on this growth business. This would equate to a stock price of around $67 per share, which gives us over a 100% upside here in a potential 2 to 3 year time frame. So really it comes down to if you believe that Lyft can grow their revenue by around $5 billion year over year, and if they can get to a market cap of around $20 billion in a few years, it would equate to a stock price of around $70 per share, assuming that there is no share dilution or any of that going on. Now, of course, you have to ask yourself, is that realistically going to happen? I think it has a good shot of happening here depending on how the economy recovers. Because like I said at the beginning, I do believe that this sector is a growing sector and there is room for more than one player to succeed in this market. So you can clearly see why I'm interested in looking at these growth type companies like Uber and Lyft, because they do hold a lot of potential over the medium to long term. I wouldn't really say a 3 to 5 year hold is a long term hold, but it is a decent amount of time. And if you're able to double or triple your money in that period of time, I think that's a very successful investment. Now guys, if you want me to continue this series on the channel, let me know in the comment section down below. I can make a monthly high growth, high risk, high reward series. But either way, if you're enjoying this video, drop a like down below and hit that subscribe button if you're brand new here as well. Anyways, now let's get into our second pick here for this video. Cloudera is our second stock here, and this may be a business you've probably never heard of before. They're a player in the cloud space and call themselves an enterprise data cloud company. So this is how their business works. They collect data, use some data engineering on it, create reports on it, create databases on it with the information, and then they finally use that to train an AI for future data. This business can really change many industries out there with their technology, from banking to healthcare companies to telco companies, and there's a lot of use cases really for the product that they've created as they've outlined in the image here. They also show that they have a ton of large customers under their belt currently, like Bank of America, Cisco, and Intel, so they are getting good footing here with some large brands and customers. From a high level, guys, here are some stats that Cloudera boasts. They had just over $800 million in revenue with 11% growth in recurring revenue, like subscription for example. They have 88% gross margin and they have 5% operating margin. All of this has led them to just over 1,000 customers acquired thus far. So Cloudera is still a small business when you look at all these metrics, but a growing business nonetheless. And what I really like about this company is that it has a subscription model which can generate a recurring revenue for a very long time. Now let's take a look at their balance sheet here to understand the fundamentals better. Looking at their assets, they have around $700 million in current assets with around $361 million of that in cash. They're looking at their total assets, they have around $2.3 billion, but the concern here that I saw was the goodwill. Goodwill is usually something that I exclude in my calculations, and Cloudera has around $1.2 billion of goodwill and intangibles, which is a massive red flag. This essentially means that their real assets value is around $1.1 billion if we remove the goodwill, which is very concerning. On the liability side, things look pretty good, around $579 million of current liabilities, and I think their earnings for the rest of 2020 should help them cover this. Their total liabilities sit at around $861 million, with $192 million of that being long-term debt. So overall, I would say it's not too bad. This isn't a debt-ridden business, which is good, and even if we remove that goodwill amount, which I don't like here on the balance sheet, they still have more assets than liabilities, so that's a positive here when it comes to their balance sheet. Okay, now here comes the fun part, using my calculation to figure out if this company is trading at a good value here today. Currently, the stock sits at just over 50% off of its highs and has been on a downward trend since its IPO in 2018. 2019 was not a good year for the stock, but so far in 2020, it's holding up fairly flat for the year. As of recording this video, the business sits at around $3.3 billion in market cap with revenues of around $800 million annually. Using my calculation, this gives them a market cap to revenue ratio of 4.1x, which is right about where I think is usually a fair value for high growth businesses. Also keep in mind that Cloudera is currently unprofitable, but they do have a path to profitability in the next 3 years or so. So if that pans out, we could see this ratio climb to a 6 or 7 times multiple, which is where companies like AMD and Tesla, for example, sit at today. So just over a 4 times multiple, I'm not really interested in buying Cloudera right away, but I will keep a close eye on this company to see if it can get down to a premium of around a 2x. So if it can kind of get to around a market cap of around $1.5 billion or so, I would be very interested in this company and adding it to my portfolio. This is because I think at that valuation, it gives me a ton of upside in the stock. I do believe that they're doing a good job at executing here and acquiring big brands under their umbrella, as we saw with the customers that they have. So it's not really a question of will this company survive. I think eventually they actually have a possibility of getting bought out by some other large player, but that aside, a 2x multiple would be a good value for this business. But similar to Lyft though, the question of course, will we see that kind of valuation again? I don't really know if that's going to happen in regular market conditions, but if we do have another stock market crasher in 2020 or 2021, it's very likely that these high growth, high risk stocks like Lyft, even Uber and Cloudera here are gonna see some pretty big declines when investors feel the fear and the volatility kicks in. So that's when it would be a good time to scoop up some shares if you are interested in either of these businesses, in my opinion. Now, I'd say both these companies give us some good potential to double or triple our money over the next 3 to 5 years if you get them at the right valuation. I think at today's prices, they may be a bit too expensive for me personally. Some people might disagree if they see bigger future prospects of the business than what the market sees currently. And if that's the case, good on you. Let me know in the comment section down below what your reasoning is, because I'd love to hear that. But either way, guys, when I'm looking at these two businesses, I would say that Lyft would be a higher priority for me than Cloudera. So we'll wait and see what happens. And if you want to know if and when I do buy either of these companies, check out the link in the description down below to my VIP group, because that's where I post all of my trades, show you my portfolio, and have a Discord to discuss with you guys what I plan to do in the market with my portfolio. But of course, like I said, let me know in the comment section down below if you want me to continue this as a series on the channel, kind of a high growth, high risk, high reward series, and I'd be glad to do that for you guys if there is value in these videos. These type of companies have the potential to really make a lot of money over the long term. Think Tesla, for example, is one of our most recent examples. That was a high risk play, but using this sort of valuation, I was able to figure out that Tesla was severely undervalued, and I wanted to really build a big position in that, and so far it's paid off very well. But either way, guys, we know there's tons of different high growth stocks out there. So I just covered 2 of them today, and if there's any others you're interested in or looking at, let me know those in the comment section down below as well. Subscribe as well if you're brand new here, and hit that bell notification so when I release another video like this, you will be the first to know. Thank you so much for watching, guys. Don't forget to invest positively, and I'll see you in the next one. Peace.